Good afternoon, and thank you for joining this webinar from Yellowstone Advisory. Today's company presenting is IMI, who released their full results on the 1st of March. We're delighted to have with us today Luke Grant, Head of Investor Relations and Group Financial Controller, and Edward Hann, Investor Relations Analyst. And I'd now like to hand over to Luke Grant to start today's presentation.
All right, good afternoon, everyone, and thanks for the introduction, Alex. As Alex mentioned, I'm Group Financial Controller and Head of Investor Relations for IMI Plc. And what we'll do today is I'll give about 15 minutes or so, just a bit of an introduction to the company that I'll start with now, talk through this slide, which covers a little bit of the strategy, and then some more of the strategic progression of the group over the last few years. And then I'll hand over to Ed, who will cover the results from the last financial year. So just so everyone's got this, the same footing. Some of you will know as well. Some of you won't, maybe don't know IMI as well. So we're roughly a 2.2 billion revenue group with about 400 million profit and sort of operations all over the world. And what we really do is we are a made to order, bespoke manufacturer or engineer of flow control products. So that could be anything from mainly valves and valve applications, and I'll talk through various different applications that we have that we sell. And it would always be looking for products that require specialist engineering knowledge. So we don't tend to do a lot of what I'd call off the shelf products. We have a few in our product portfolio across the group, but generally always bespoke products that are controlling flow of motion, whether it be gas, liquid, air, and it could be in something like a heavy duty truck, it could be in a power plant, it could be in a life science diagnostic machine. So we operate across a lot of different end markets, but always looking for opportunities in the flow control space. Good, yeah, and so what brings us here today? So the last sort of 4 or 5 years, we launched in November 2019 the strategy that is currently running today, and that's built around the purpose, which is shown on the slide: breakthrough engineering for a better world. And I think that purpose has resonated very, very well with employees, with our customers, with the city as well, in terms of how we are doing things like reducing 80-90% of CFC emissions in power plants by implementing better valve technology with lower leakage, or improving the ability to test your blood for pathogens by having micro dosing valves and so on. So wherever we look, I think the products that we are doing are helping support a better world. And how we like to think of our business. So I talked about us being a bespoke manufacturer. And I think to do that, we have to have very, very good engineering capability, and we have to be experts at working with and dealing with our customers. So customer satisfaction is absolutely crucial to our strategy. And in 2019, we also launched Net Promoter Score, which is the way that we measure our customer satisfaction. And you measure that from -100 to 100. Any company sort of 40 and above would be considered to be industry leading. Apple runs at about the low 60s, which one of our businesses is roughly around about that level. But we're pleased to say that all 5 of the sectors that we operate in have industry leading customer satisfaction scores. So it really moved the dial forward over the last 4 or 5 years significantly in terms of how we deliver to our customers and how they perceive us as a supplier. The second pillar of the strategy is market-led innovation. And really what that means for us is how we innovate new products, bring them to market, and gain traction and growth a lot faster than we have done historically. So, and we use something called the Growth Hub. So we have an innovation, well, really it's 40 or so concurrent teams that will be between 5 or 8 people, like constantly testing ideas with the market, with customers, looking whether or not there's significant enough problems for us to innovate solutions. And if they're not, we'll quickly kill them, and we'll go through some different examples as well as to how we look at that. And it's 3 or 4 years in now, and I think the orders have gone from like 6 million to 23 million to 52 million to last year. So 2023 there were 89 million. So you can see how the innovation pipeline is really, really grown. We've got over 10 projects now with more than 1 million orders come through that. innovation hub. So really kind of stepping up the incremental organic growth in the business. And then lastly, I mentioned we're about a 2 billion revenue group, and we had sort of over 50 manufacturing facilities. So complexity reduction, that's quite a complex manufacturing footprint relative to a £2 billion group. And we've been systematically going through and making our manufacturing footprint, supply chain a lot more simple relative to history. So, we've closed a lot of manufacturing facilities, but a lot of manufacturing now in Mexico, the Czech Republic, in Poland, in India, so that they're in lower cost places, and also they're more consolidated. So we have a lot less supply chain risk. And I think that program is coming towards an end. But it has been going well, and that's what's helped some of the margin development. And actually, we took a step back in July last year. So I did a presentation with Yellowstone and Alex and the team last year. So since I did that last presentation, we've launched our financial framework, which is on the right-hand side of the page, which is trying to give a model to everyone, just a very simple model of who we're trying to be. So organic growth of 5% through cycle, adjusted margins of 20% through cycle, and then cash conversion above 90%. And then we look at a fully burdened return on invested capital. So it adds back all goodwill, acquired intangibles, anything that we've spent in cash, to really measure the return to the business to make sure they're accretive for shareholders. It's not just a balance sheet return on capital measure. Cool. And so I will move on to looking at how we are structured as a business. So in terms of how we think about that 2.2 billion revenue business, we operate across 5 markets. And we have this year announced a new structure of our business. So previously we were organized in 3 divisions that were called IMI Precision, IMI Critical, IMI Hydronic. I think quite difficult, really in terms of how we run the business, to think of ourselves in focus markets before we did this change. So we now have 5 global market sectors that we work towards, that we operate in, that we look to grow in. And that's what's shown on the slide. So now we think of ourselves as process automation, which is about 37% of the group, so just shy of 40%. It's the largest sector we have. And that principally sells applications into the energy market. So whether it be LNG, into gas, into oil, into nuclear, and then also 20% of that business is selling into marine and pharma, and the markets that business is operating and doing really well. So they are the harshest valves we do. I was in a facility in Germany last year, and I think we shipped out a valve that weighed over 80 tons. You have to close the roads at night in the facility to get the haulage truck in and out of the town where the facility is, just to kind of give you a feel for the scale of which we operate in. Which, as we move along, you'll see that we have very different scales that we operate in across the flow control markets we have. Industrial automation, that operates mainly within factories and a little bit in rail. It's about 25% of the business. And what that does is things like pneumatic actuation and valve control. So the sorts of things we would do is we talk about us being a bespoke manufacturer. So there are other players in this market that do more standard product. The products that we do would be things like, instead of doing an aluminium actuator that moves backwards and forwards, moving apart in a machine, we would bespoke manufacture a stainless steel actuator, and that would be used for some, like a harsh application, like a wood chopping machine or something along those lines, and it would run for millions of cycles without breaking, which is very different to say how a standard product would operate. Climate control, which is the third largest sector, is just shy of 20% of the business. That's where we are selling into. You might even have some of our products in your house, things like Heat Miser, which is a smart connected thermostat, or we do thermostatic radiator valves, but also we do a lot of the balancing and control around big large buildings. So we're on hospitals, we're on things like the Maracana Stadium in Brazil. We do all the balancing around the Burj Khalifa as well. So we do all ends of both. Well, it's roughly 50% residential and 50% commercial buildings in that market. I think life science and fluid control, so everyone understands what that is. It's about 12% of the business, and it's roughly half of it is life science and half of it is fluid control. In life sciences, we do products that support with things like microdosing. there will be a valve that controls the dosing of reagent into your blood, and then your blood will be tested for something like 240 pathogens in a testing machine that your doctor would send off to the laboratory. And we keep designing the latest machines that haven't yet been released are the ones that will now sit on a doctor's desk, and they will test your blood within 15-20 minutes while you're at the surgery, rather than it getting sent off to the lab. So the microdosing is getting smaller and smaller. And the other half of that business, the fluid control part, about half of that is food and beverage, and we sell into things like we do all the valves for coffee machines on the sort of flow control of liquid through a coffee machine, and we do of modern day farming technology as an example. In larger farms, it'd be less prevalent in the UK just because of the size of the farms, but you have geo mapping technology attached to valves at the back of a fertilizing tractor, and they will only open when the geo mapping technology tells you that the field isn't growing as fast as it could do to efficiently dose fertilizer, which is obviously much better for the environment, much more cost efficient. Lastly, only 8% of the business, but we sell into heavy duty trucks and transport, and about 40% of that business helps with diesel emissions reduction and wider sort of NOx reductions, which I think we've helped reduce NOx reductions over 90% on heavy duty trucks over a number of years. And then also we do a lot of the thermal management, the chassis. We do the pneumatic actuators that control the seat for the driver. Hopefully that gives you a good flavor of what the business does. So always flow control, but across a number of end markets, always bespoking manufacturing, to a very tight specification for our customer base. And in terms of just how that looks like in the 2023 results, I'll just sort of quickly come on to this slide here. So I'll talk through the rough size of each of these 5 sectors. And I think what's really driving growth over a longer period for these sectors. So process automation, we talked about being principally an energy business, and I think there's a huge wave of investment going into the energy markets at the moment because of perhaps a bit of underinvestment over a 5-10 year period in the 2010s to now. Seeing a lot of drive for each country having more of their own energy supply following Russia's invasion of Ukraine, and then also there's a big drive for decarbonisation in that part of the industry. Industrial automation, people are getting more expensive, it's getting harder to get labor to do more manual tasks. So I think a lot of semi-automatable production processes are now moving towards being automated because the paybacks on those projects are getting a lot shorter. We're also seeing good growth drivers from reshoring across into the US and into China that are just helping support the growth of that business. I think the climate control business, I think a significant portion of Europe, it's mainly a European business, climate control, and a significant portion of Europe's energy usage is coming from buildings. So anything we can do to reduce energy usage and make the energy efficiency of a building or a home better is really where our products come in. And we're usually something like 3% of the cost of the system, and we influence about 30% of the energy efficiency or savings of the system. So we've got a really, really good niche within that market, and we do see growth drivers from regulatory changes made, particularly in continental Europe. Life science and fluid control, I think the desire to live longer, to have better health and have better knowledge about your health is really what's driving a lot of the growth there. And then in transport, the smaller segment, it's more around emissions reduction, safety and comfort for the driver. And there's also regulation driving some of that. And you can see the fastest growth driver there for us is in life science. I think that's where we see the fastest growth over the long term, and transport maybe a little bit slower, just really reflecting some of the cyclicality of that business. And in terms of just some examples of actual tangible things that we've done, I talked about our growth hub recently. Earlier in the call, and part of that we have been starting to win some quite nice orders in hydrogen. So when we launched the strategy in 2019, I think hydrogen orders would have been less than $1 million for the group, and we've sort of gone through the growth of process over maybe a 2-year period and identified areas like PEM electrolyzers and hydrogen refueling stations, and been winning some nice orders there. So our electrolyzer business, which is the one that's shown in the picture, which is a sort of roughly a 40-foot container that can convert fully green solar energy into hydrogen and store it for use at another time. has gone from, I think, 2 million orders in 2022 to 9 million orders in 2023. So, significant growth year over year. And we see another route to good growth again into 2024 and beyond. And, hydrogen fueling stations as well has gone from basically nothing a few years ago to now about £5 million worth of orders. It's a very harsh technology. Hydrogen's a very difficult molecule to store, so it fits right on our sweet spot of bespoking products for customers to sort of work in those environments. And then Heatmiser, which is actually, it's a UK-based business up in Blackburn. It's probably the market leader in the underfloor heating space in terms of smart connected controls. We've now launched that product out in Germany and France, and we're going to keep rolling that out further into 2024. And then, the Adapters acquisition, which is the largest one we've done in this strategic cycle. We're now working through the pipeline of synergy orders. We already won a few reasonable size orders last year, and see a good route to continuing to grow the order pipeline and growth of that business. And in terms of how we think about allocating capital within our business, so I think we've increased R&D as a percentage of sales from 2.4% in 2019 to now 3.3% of the last 2 years. So that's about an extra £20 million a year going into investment for growth into the P&L every single year. We've put a target out to keep that above 3%. The growth hub we've talked about, and then we continue to invest capital into the business every year to continue fueling future growth. And then we've done 4 or 5 acquisitions, so deployed about £400-500 million of capital into acquisitions, which roughly equates to about 5% of revenue. And I think those acquisitions are doing well. We have very stringent returns hurdles to make sure the acquisitions are delivering well for the business. And we're going to look to continue to do similar size bolt-ons that, like Heatmiser, that will continue to sort of grow the business faster, be in faster growing markets with higher margins than our core business. And then finally, obviously absolutely crucial is the dividend that we pay out every year, which we've increased 10% compound the last 2 years. And I think we see a good opportunity to continue to progress increasing the dividend. And we have always said that we would consider share buybacks should our net debt to adjusted EBITDA ratio reduce below 1 times, which we did, as you can see on the chart, in 2021. And we'd certainly consider doing that again should that opportunity arise. And just looking at how the portfolio, so for any of you that have looked at IMI a number of times over the last 10 years or so, I've worked at IMI for 10 years myself, or 11 now, so sort of been here through this time. And you can see the geographic progression of the group. We were acquired a little bit into North America, so I think the geographic spread of the group is a lot better in terms of looking at how we grow into medium term. I think I'm sure everyone will agree the US is a great place to grow, and there's lots of growth opportunities out there. But I think importantly at the bottom of the slide, we weren't particularly growing between 2014 and 2019. Actually, average organic growth was -1% through that period. And I think you can see through the strategic cycle, the first sort of 3-4 years, including COVID, obviously, which is challenging year for many companies, we still managed to eke out sort of 3% plus of organic growth. And actually, the last 3 years have sort of been averaging above that 5% organic growth target we have. And I think it's now just about how we consistently compound that year on year. And what's really helping support that organic growth as well is the focus on aftermarket we've had in the group. So the aftermarket content of our revenue has moved from 35% to about 45%. It's actually a little bit above 45% in 2023. So we can really see how we continue to grow the installed base that we have and harvest that over an extended period with lots of good growth market exposure. I think ESG is really fundamental to the strategy. It's a better world strategy. So as well as what we are doing to support our customers, reduce their emissions, make their processes more efficient, more productive, safer, I think we're also, since 2019, we've reduced our Scope 1, Scope 2 emissions by 29%. And then, we've got our targets for net zero by 2040 for Scope 1 and 2 and 2050 for Scope 3. So we're going to keep working on that. We're really sort of ramping up reduction in water usage as well, even if water isn't we don't use a significant amount relative to some other industries, but we're still working through reducing those. Yeah, and part of I would say roughly 10% of our capital spend per annum now is going into pure energy efficiency projects. So things like solar PV rollouts. You can see the car park in our California facility on the right. I think at the half year we put another couple of facilities in the pictures if you're interested to have a look where we've put more solar rollouts, but also doing more on energy efficiency. We've still got very high employee engagement, 77% it was for this year. And then the board is 44% female, and the execs now 50% female. And then in terms of how that's actually delivered into financial results over a 5-year period since the strategy was launched, I think, even given you've got COVID, you've got the invasion of Russia, Ukraine, and various other things, supply chain crisis during this time, I think we've been very consistently growing profits now at a double-digit CAGR over this period. So just to sort of cap up on the strategy of the group section, I think this purpose-led strategy that has been delivering both improved margins and better organic growth, which is resulting in more sustainable, profitable growth. I think we've got nice, attractive markets that are supported by global macro trends that we talked through. We've got a nice portfolio of businesses that offers a lot of resilience through different cycles, and I think we've really demonstrated that well through COVID, through the supply chain crisis, through Russia, Ukraine over the last 4 or 5 years. Even sort of recession in Europe last year, we still managed to eke out a good bit of growth. We're very cash generative, which leaves us with a strong balance sheet, giving us a lot of flexibility to continue to progress the dividend, continue to invest in M&A, think about share buybacks as well. And most importantly, the last one is that we're really helping our customers deliver well for their projects. So with that, I will hand over to Ed.
Cool. Thanks very much, Luke. So I'm going to talk through our 2023 financial performance in a bit more detail. We go on to the next slide. Perfect. So very pleased to report another strong financial performance in 2023. We delivered 7% sales growth, 6% of which was organic, and our adjusted operating margin was at 18.7%. So that's 90 basis points higher than last year, and getting close to our 20% target. Adjusted profit before tax was up 12%, and we delivered significantly improved cash flow. Our complexity reduction program delivered another £20 million of benefits in 2023, and we expect to deliver a further £15 million of benefits in 2024. And finally, flagged, the order book within process automation is now at a record level, which will provide good momentum into this year, and we've proposed a 10% increase in the final dividend. Go on to the next slide, please, Luke. Now, this slide just provides a bit more detail on our financial performance, and you can see it was a very, very strong performance across the board as we make good progress with our purpose-led strategy. So I'm now going to talk through this in a bit more detail. So on the next slide, there's some more detail about our revenue and profit performance. So as I mentioned, revenue increased by 7% to £2.2 billion, and we delivered 6% organic growth, around 2/3 of which was price. And you can see that recent acquisitions have also contributed positively to our results. On the right-hand side of this slide, you can see that the adjusted operating profits increased by 13% to £411 million, and organic profits increased by 10%. And again, you can see we've benefited from our M&A activity. And as you can see on both charts, there was no material FX impact in the year. So on the next slide, it's got a bit more detail on our margin progression in the year. Now, we've made significant progress delivering sustainable improvements in our margins since we launched our strategy back in 2019. And last year, we delivered margins at 18.7%, which is well up from the 14.2% we delivered in 2019. Now, we are getting closer to our 20% through cycle margin targets, and the good news is that we've got a clear pathway to deliver on that commitment. So firstly, our complexity reduction program is progressing very well and should provide a further £22 million of incremental P&L benefits in the next 2 years. And alongside some further growth in the attractive sectors that Luke's already talked through, should see us delivering margins in line with our through cycle targets. Go on to the next slide, please. Just talk through the income statement quickly. So as mentioned, strong organic growth in both revenue and operating profit in the year. I guess looking at the bottom half of the P&L, the net interest charge increased to £23 million, largely reflecting the increased rate environment. And adjusting items did increase last year when compared to the prior year period, largely reflecting the progression of our restructuring program. And you can see right at the bottom there that our basic EPS, or adjusted basic EPS, increased by 11% to 116.8 pence. So on the next slide, we'll just talk through the performance in some of our key sectors. So So looking at the platform starting with automation. Automation, so that's the process automation and industrial automation sectors that Luke talked through. So automation delivered strong revenue growth of 8%, both statutory and organic. Process automation had an excellent year, delivering strong order intake, as shown at the bottom of the slide. Orders were up 18% organically, with a 23% increase in the aftermarket. Organic revenue was 14% higher than 2022 and 13% higher on an adjusted basis. We have benefited from our own self-help initiatives, particularly in the aftermarket space, where we're accelerating activity, retrofitting both our own and our competitor installed valves. And we've also benefited from continued investments across the economy in energy security. I've seen particular strength in LNG, nuclear, downstream oil and gas. So industrial automation, the other part of the automation platform, delivered a resilient performance in a year when PMIs were sub 50 in most territories for most of the year. Organic revenue was in line with the prior periods and at 1% on an adjusted basis. And we see continued demand for our solutions that automate processes in a competitive labour market. So turning to Life Technology, our second platform. The platform delivered a good performance in the year in a place with very mixed end markets. Revenue was up 6% and 2% on an organic basis. So climate control saw good demand for its energy saving products. Revenue was up 3% on an organic basis and 10% on an adjusted basis, so including the Heatmiser acquisition. So the recent slowdown in the European construction markets did impact sales in the second half, but the sector continues to perform resiliently due to demand for products that enhance HVAC system efficiency and give us customers the energy efficiency products that they're looking for. So Life Science and Fluid Control revenue was 4% lower than 2022 and 5% lower on an organic basis. We did see customer destocking and reduced demand in the second half in line with the sort of peers in the sector. But the long-term fundamentals of this sector are strong, and we do remain very excited about the long-term opportunities for growth. So finally, transport. So transport revenue was up 14% when compared to 2022 and also at 14% on an organic basis. So growth was helped by our customer supply chains normalizing. We've also benefited from strong demand in China and India, as we've seen some new contract wins on particular truck platforms over there. So we've also benefited from strong margin growth in both platforms, and that was supported by the continued progression of the complexity reduction program that we sort of talked about on previous slides. Can we move on to the next slide, please, Luke? So we did highlight this at our interim results, but I think it's important to flag that we do see a clear pathway to delivering a step change in cash flow generation, and we took a big step last year. So you can see on this chart that free cash flow generated improved significantly from £158 million in 2022 to £234 million in 2023. So that was great progress. And we do see a clear pathway to delivering free cash flow in excess of £300 million per year. And that'll be through a combination of continued growth in our high margin sectors and the delivery of our remaining complexity reduction initiatives. So just on the next slide, we've got a quick overview of the outlook statement that we issued to the market alongside our preliminary results. So based on the current market conditions, we expect full year adjusted EPS to be between 120 pence and 126 pence in 2024. So this guidance reflects strong growth in our automation platform, supported by the record order book in process automation, and continued resiliency in the industrial automation sector as the competitive labour market drives investment. Life Technology is expected to be broadly flat in the full year, reflecting continued demand for our energy efficient products in climate control, offset by softer markets in Life Science and Fluid Control and transport. So our group operating profit delivery is expected to return to its normal phase in the year, which is an approximate 45-55 H1, H2 split. And we do expect further margin progression in the year towards our 20% targets. Now, as you can see in the bridge, we expect to see our interest charge reduced to about £17 million in 2024, offset by a higher tax rate, increasing from just under 22% to 24% this year. And we also see FX creating a headwind of around 2% on sales and profits. But that's all considered in the guidance and takes us back to our range of between 120 pence and 126 pence. So just to summarise and to wrap up before we move on to Q&A, some key messages from the presentation. So firstly, the purpose-led strategy that we set out in 2019 continues to deliver results. We delivered a very strong financial performance in 2023 with organic revenues up 6%, the adjusted operating margin up 90 basis points, and our adjusted EPS up another 11%. So secondly, as announced in July, we've organised our group into these 2 platforms focused on 5 key market sectors, all of which are supported by long-term secular growth trends that will support the delivery of sustainable, profitable growth. And third and finally, as I just outlined in the outlook statement, we are targeting another year of earnings growth. And based on the current market conditions, we're expecting that this year's full adjusted EPS will be between 120 pence and 126 pence. Perfect. So I think with that, I think we're handing back over to Alex for the Q&A session.
Great. Thank you very much, Luke. Thank you very much, Edward, for that introduction to the company. And I guess if you're new to the story, hopefully the high quality nature of the business came across. We're now going to take a Q&A. And if you do want to ask a question, please type it in at the bottom of your screen. We're going to try and cover as many as we can. So I'm going to kick off on a question that's coming on cash flow. So bearing in mind the strong cash flow, are there any future plans for buybacks?
Yeah, so I think as we ended last year, our net debt to EBITDA ratio is about 1.3 times. And we think about an efficient capital structure for us would be to operate our net debt to EBITDA ratio between 1 and 2 times. And we de-lever about 0.5 times a year. So, assuming we do no share buyback or acquisition during this year, our leverage will probably end up at about 0.8 times at the end of this year. So I think based on our stated capital framework, we will definitely give some serious consideration to share buybacks. Should we get to the point that our leverage falls below times, which I said will be kind of towards the end of this year. So it may not be in this year, but certainly if we head into next year, that would be a natural time to consider doing them. The only thing I would say is, of course, we continue to look at M&A, and acquisitions, and we've got a healthy pipeline. We've done 5 acquisitions or so in the last 3-4 years. So if we did an acquisition, that might mean we don't do a share buyback. But assuming we did no acquisitions, then potentially.
Okay, thank you. Next question. How robust is your moat as a business in the sectors that you choose to focus on?
Yeah, it's a good question. So I would say very robust. I mean, don't forget 45% of our revenues are aftermarket, and we're basically a made-to-order business. So most of our products are specified by the customer. So once we're sort of in and on the platform, we have a very, very robust base. We do have various IP, intellectual property in a lot of different of our end markets, but a lot of our sort of secret sauce comes from applications engineering. So it's having very, very knowledgeable engineers that are able to bespoke existing products, actuators, valves into a niche application. Like in life sciences, one of our valves is fully open and closed is about 1/10 of the width of your hair. And within that, you have like 1,000+ settings. So you kind of get to the idea of how bespoke and accurate the products are across our product portfolio. But I think in process automation, just to quickly run through the 5 sectors on this, obviously most of the valves weigh well over a ton, if not 10, 20 tons. There are only a handful of people in the world that can do what we do. In some markets, there's only 2 players, let's say. So I think we're very well protected in that, which is our largest segment. Industrial automation, of course, there are players like SMC, the big Japanese company. They tend to focus more on standard products. So I think where we compete with them, there will be less protection there relative, just to answer the question fully relative to the rest of our business. Clearly, we're working with smaller customers on bespoking parts. So that's how we sort of see ourselves well protected. And 40% of that business is our aftermarket. And climate control, we are influencing design specification. So, that's how we influence in terms of getting our products in, and we're a premium product, across all of IMI, we're a premium product. And I think I talked about as being 3% of the cost of the system, but 30% of the energy efficiency or savings of the system, which is really why we're an absolute crucial part. I think in life sciences, fluid control and transport, we're generally just working with larger customers. So there's maybe anywhere between 10 to sort of 30 customers in each of those 2 sectors. and we are bespoked in on specific platforms, whether it be a truck platform, like a specific truck Scania is making or something, or in life sciences, maybe a machine that someone like Thermo Fisher is making. So again, we're on those platforms for 3 to 5 year or so, depending on the life of their truck or life science diagnostic machine.
Okay, thank you. Do the growth percentages include or exclude inflation, i.e., are they real or nominal?
Yeah, I would say that they include inflation to keep it simple for everyone. So I clearly in the last 2 years specifically, and Ed referred to the fact that 2/3 of our growth has come from price rather than volume. Price has been a larger component over the last couple of years. I think in a normalized period, we would probably expect pricing to be maybe like 1.5% to 2%, something like that, just to kind of give you an indication of like how much would be priced to offset inflation versus volumes, which would be more like sort of 3% of the growth, something of the 5% growth target we have over. If you want to think about a decade, which is like roughly the sort of time frame I'm thinking.
Thank you. How important is the US Inflation Reduction Act to drive further growth for IMI?
Yeah, I think it's generally a good thing, I would say. So we have already seen a few contract wins, particularly in industrial automation, as a result of that. Now we should remember that Inflation Reduction Act would be things like it'd be like a tax credit for our customers. So it's sort of like an indirect benefit to us. Where we've seen it is a lot of investment going in the US for production facilities that are in the sort of supply chain of EVs, electric vehicles in the automotive sector. And we're selling pneumatic actuators and valves into those facilities to support the production process of it's not always on the car itself, but just somewhere in the EV supply chain, maybe something more in the battery element of the production process. And also, a lot of good wins in the agriculture space as well, over in the US. So I think it is a soft tailwind for us. I think it's difficult to it's not large enough for us to say like 2% of our growth will come from it or something like that. It's more just marginal wins around the edges, but it's definitely we'd rather have it than.
Okay, thank you. There's been a big improvement in operating margins over the last 9 years to 18.7%, and you've got a through cycle target of 20%. What does that mean for variability? In a good year, could margins get to 24, 25, and in a bad year, will they get back down to 15, 16%?
Yeah. So we ended this year at about 18.7% ended 2023, and we've got the target for 20. So I think we are, particularly as we continue to improve the share of the business that sells into the aftermarket, it's gone from 35 to 45%. I think that makes us a much less cyclical business relative to history. And therefore, I don't see margins going along the ranges that you're referring to. And we sort of gave on the margin bridge that Ed presented, showing us getting to the 20. We gave a bit of an indication of how wide we see that window, because the starting is at 18.7, and the window we give looks 100 to 150 basis points plus or minus around the 20. I think rather than letting margins get out of control and go up to 25%, which we could possibly do, right, as a group, just given the markets that we described, the pricing power we have, and so on and so forth. I think much more important to us is about reinvesting for future growth. And I talked about, R&D as a percentage of sales has gone up from 2.4 to 3.3%. So even with the margin improvement that I presented from 14.2 to 18.7%, we've got over 100 basis points of investment that have gone back into the business over that multi-year period. So we could already be at 20% margins today. I think much rather is have a more sustainable, faster growing group. So if you think about our financial framework, 5% organic, 20% margins, we'd rather increase that growth target, say 5 to 7% rather than 5% through cycles, or as we get more confidence in the strategy, and keep margins around 20% with a lot more investment going back into the business to fuel future growth.
Okay, thank you. Got a linked question that's come on the back of that. What's the margin on the aftermarket business?
Oh, that's really good. It's very difficult to calculate as an operating margin because you've got shared facilities. So we don't actually sort of sit and live and calculate that as such, because obviously you've got new construction going through the same manufacturing facilities as aftermarket. But probably our largest segment is process automation. to give you an example, and the gross margins of our aftermarket are 2.5 times the new construction margins. That's where it's most extreme in the business. So the gross margins will be like 55 to 60, and the in the aftermarket percent, and the new construction business would be more like 20 to 25%. So still accretive relative to our operating margins. It's not quite a full razor blade model, but it's sort of in that. I think in industrial automation, which is the next biggest sector, aftermarket margins are probably around about 60s, but the new construction is more like 40, so it's about 1.5 times. In climate control, it's generally just got pretty attractive gross margins throughout, but you'd see sort of aftermarket margins north of 55%, definitely. Life science and fluid control and transport, it's less of a new construction aftermarket play, right? You know, we sell a product into a truck that goes into an emission system. It needs to just work, period, right? So we don't really focus so much on the aftermarket. It's more about getting more content per truck. Or similarly for a life science diagnostic machine, you know, you want it to work for the life of the machine, but we want to get more content per machine as the new platform comes on every sort of 3 to 5 years.
Okay, thank you. And just as a reminder, if you do want to ask a question, please type it into the chat box at the bottom of your screen. Got a couple of questions on EPS growth. So consensus EPS growth from analysts is only 2.7% at the bottom end and 7.5% at the top end. Are you expecting 2024 to be a tough year for IMI?
Yeah, no, I don't think so. I mean, I think our fastest growing, our biggest segment, process automation, came into the year with a plus 21% order book, which is a 9-month order book. So, and we've already guided to double-digit growth for that segment within our results. I would say the rest of the business has slightly tougher end markets. You know, industrial automation, alluded to manufacturing PMIs hovering around 50 or even below for the last 18 months, which would generally indicate low investment in factories. I think climate control, you know, it's mainly European business, and European construction is slow, albeit we're mainly a retrofit business. We're about 70-75% retrofit, something like that. So we're more tied to, you know, the kind of the aftermarket revenue stream there. But, you know, if new construction slows, it's not a help for us for sure. Life sciences has had a tough period, and then transport, the truck volumes are due to go down. But I think, you know, if we really strip back our guidance, so 120 to 126p, as you said, it's sort of a 3 to 8% growth target. Let's not forget there's a 2% FX headwind in there, which is kind of out of our control, right? We can't really do too much about that. And then also the new Pillar 2 tax rules and the UK rate going up is also a headwind as well. So at its purest format, I think our guidance is for around about 10% growth, you know, excluding tax and FX, which, you know, it's kind of like governmental driven or markets driven, right? You know, it's not really something we can too heavily influence. So I still think we're planning on, yeah, if you asked me when we were doing the budget, you know, a few months ago, would I be happy with 10%? I'd be like, it's a good start.
Okay, thank you. How difficult is it to recruit staff with the right skills, and what is wage inflation running at across your businesses?
Yeah, so I'll take the last one first. So wage inflation is running about 4.5% this year, something like that, which is compounding, don't forget, on a year that was about 5% last year as well. So it's still running pretty hot, I would say, and particularly given some of our workforce are in Mexico, Poland, Czech Republic as well. You know, you've probably got 30-40% of the workforce in those 3 countries at least. And inflation's running in those countries at double digits. And we are, of course, consciously as an employer making sure that everyone is on a living wage as well, which means, you know, as a large listed company, we are probably giving more than the average, even in some instances, to make sure we keep up with living wage in those areas. I would say, do you know, it's really interesting. You asked me about 18 months ago, I'd say skills shortages. Yeah, you know, you're definitely thinking about machinists and things like that can be complex to get in certain locations. I mean, we've got a fairly diverse manufacturing footprint, as we discussed at the top of the call. Actually, anything material from a recruitment perspective, not really, no, because it tends to be very localized to, does like an Amazon distribution warehouse get set up 2 kilometers down the road? But even when I remember something like that happened at one of our facilities out in the States, and you saw high turnover initially, and then actually a lot of those people came back because, you know, the working conditions are, you know, maybe better at IMI, and people just like the sort of more, let's say, family feel you get from a slightly smaller company, recognizing we have 11,000 employees, so not that small, but yeah, so not really, I think, at the moment. But it's, you know, it's always a fight for top talent, right, in whatever market, you know, in engineering, sales, you know, managing directors, so on. So we're always focusing on it, but I think the better world strategy definitely has been a positive for us out in the market.
Yeah, thank you. We've got a couple more questions to go through here, and I think we've got time to cover them both now. So the first one is what are the synergies between the different divisions?
Yep. So as we look across the business, everything we do is flow control. So there's a lot of engineering expertise shared across the business, particularly in areas like hydrogen that we discussed, and even process automation. The engineering director for the largest part of the business that's in the most severe valves actually has moved across into the climate control business. So we do share a lot of talent across the group. I myself have worked in 3 of different sectors over the last 10 years. So there's a good ability to share talent across the different markets that we have. I think there's some shared manufacturing, there's a lot of shared offices, a lot of shared legal entities. So from a back office perspective, we have things as well aligned as possible to make sure that we're running things as efficiently from a cost perspective. And then I think the other thing is in the automation business, industrial automation and process automation are doing very similar things, just at a different scale. So we're now investing in software systems and those sorts of things across those 2 businesses now that we've put them together, which gives us a much bigger platform for investment. And then similarly, in the other 3 businesses, so climate control, life science and fluid control, and transport, they fit together really nicely because we're always doing like a small component within a system. But our design engineers have to be experts in the heavy duty truck, the HVAC system of a building, or the life science diagnostic machine. And therefore the engineering, the way we think about engineering in those areas is very, very similar.
Thank you. We've got one more question that's come in, so we've got two outstanding still. Who are the main competitors in the various divisions?
Yeah, so process automation, the largest sector. The main competitor there, I would say, is Emerson, the big US company, and then after that, it probably trails off into a lot of smaller companies. You've got people like Mason Elan in there as well. In industrial automation, so we're probably like the number 1, number 2 player in the world in each of our own markets in process automation. I think industrial automation, you've got people like SMC and Festo. So SMC is a big Japanese company. Festo is a private German company. They're probably the number 1, number 2 player in the world. We're probably number 3, I would say. And then climate control, we're usually probably the number 1, number 2 player in the world in most of our markets there. But you've got people like Danfoss, Alberts being other companies that operate in that space. In life science and fluid control, we're probably the number 1 player in the market. It's probably the reason why we think we'll grow faster in that segment relative to any others. Maybe Parker would be an example of a competitor in that space. And then finally, in transport, Wabco would be an example of competitor. So usually it's us or them, number 1, number 2 player in the world.
Great, thank you. And then the final question, can you indicate the typical market shares across your divisions?
Yeah, so in process automation, we talked about us and Emerson as the major 2 competitors. I think we have something like 180,000 or so installed valves globally across 12,000 or so power plants, and our competitors have about somewhere between like 280,000 to 300,000, something like that. So we're about 35% of the market share. Emerson probably about 30, and then it sort of quickly trails off into lots of different people thereafter. In industrial automation, we're probably about 10% of the global market share. It's a really fragmented market in that market, so there are lots and lots of players that do pneumatic actuation and valves for factory automation. So it's a relative to the market, it's a reasonable market share. Where are we next? Climate control. Yeah, in our largest company like Germany, it's publicly printed numbers, but we have a market share kind of around 50-ish%, something like that. So pretty significant there. And it's pretty high then in the other major markets like the Nordics and Switzerland that we sell into. And then life science and fluid control, quite difficult to give market share actually for that particular market, just given it's a fairly concentrated market, but I would say it's pretty high again. And then in transport, we sell into all of the top OEMs in the world that make heavy duty trucks.
Brilliant. Luke and Ed, thank you very much for the clear presentation and answering all those questions. Thank you to everyone for attending.
Thanks, everyone.